you are concerned, markets breathing a sigh of relief, you're still concerned about the rise of nationalism, about anti-trade, anti-globalization in Europe.
Absolutely, and more as a long-term trend rather than sort of a short-term outlook. If you look at the French election in '92, when basically the Front National made it to the final, they had roughly 3 million supporters. Now it's been 11 million. And so there is a rise in these forces, and the bigger concern for me is not really the immediate future. I think the immediate future will see a relief rally for the euro. We'll also see some stronger data coming out of Europe. PMIs are very high. So I think there's no problem sort of for the rest of this year. But we'll move into Italian election next year, and there's a very strong anti-European sentiment, anti-Euro sentiment. So there's more problems ahead. And actually the British exit, the Brexit, is a countdown that is happening now with problems that will only be solved in the 12th hour. So there's more volatility ahead over the next, 2 years at least for Europe, and that's going to be a rocky road.
You actually raised the possibility when you were talking about this earlier that Brexit is much more than a risk to just the UK. It's a risk to all of Europe, potentially. A big one, you said, that could hurt the economy and even spill over into global markets, global economy. What is the chance of that, and how is that going to happen?
It's like every event. Markets are really not good at pricing binary events. Binary event could be a hard Brexit, and from what you hear from the British government, they want to have influence over immigration, so they're not part of the common market, and they want to have trade agreements with the rest of the world, so not part of the customs union. That is the definition of a hard Brexit, and there's very little on the continental European side that will be coming forward to accommodate that British exit. It's self-chosen, and so I think there will be a pretty hard exit at the end, and that will have very negative repercussions on Europe, on both the continent and on the UK, and it will spill over continuously over the next 2 years into market volatility. Every speech the Prime Minister gives, every election outcome will be priced by market, and so there will be ups and downs, short relief rallies, more concerns, and it'll just emanate volatility into European markets for 2 years to come. And banks like us have to choose strategies that will basically make sure that we can be of continuous service to our clients throughout Europe, both in the UK and in Europe.
Got to ask you about the European Central Bank then, because you just said how well the European economy is doing. A lot of people are saying, hey, come on, Mario Draghi, get with it. Start telling us when and how you're going to taper. Move in that direction. But you just talked about a lot of market volatility. So much uncertainty. Is it more prudent for the ECB to wait? Is it more prudent for Mario Draghi to keep stressing, hey, wait, I want to make sure the rising inflation is sustainable, and keep his eye on what's going on when it comes to politics?
No, I think we're in a different inflation environment. Sort of inflation is now closer to target, and the extreme monetary policies that have been enacted by central banks have to be scaled back. I mean, it was the right thing to do 10 years ago to move aggressively with monetary policy, but just as much as it was right to do it then, it's wrong to still be on the same monetary policy course 10 years after the crisis. So they have to scale back. My expectation is that in June they will remove some of their easing biases that they still have in the language, and around September probably announce that they're going to taper their purchase program, which they will do over 6 to 9 months in 2018. So come mid next year, we probably will have the ECB with a stable balance sheet, and we will talk about interest rate movements after that. So I think the ECB is clearly on a path to normalization, yet they're following the Fed with some delay. And of course, like the Fed, they're data-driven. So if anything were to go wrong in the economy, they might change that course. But given the data and how they line up now, I think it is likely that they will follow this course.
So speaking of the outcome of the French election, you said short-term relief rally. You can see that, and you have to develop a strategy. So with the sigh of relief in the markets on the French election, do you think client activity is going to improve at UBS? Do you think your transaction income will, say, be a little bit better in the second quarter?
Well, we've already seen a very good first quarter, and so I think we don't say, you don't multiply the first quarter by 4, because we are still in an unprecedented environment. But there is some disconnect between financial markets and the underlying economy. The underlying economy looks good. I mean, Europe even looks stronger on PMIs than the US, and the first quarter in Europe was stronger than the US with an upward revision of the 4s. So I think there's going to be some improvement in Europe. We actually think that we're long in stocks, so we still continue to believe that markets will do well, and the Fed will basically normalize policy in a steady path. So they will be very data dependent, and they will be cautious and gradual, and that will not undermine stocks. And so in general, I think we have a good outlook for the US and for Europe. So the markets are going to be pretty benign. Volatility, and your commentators mentioned that, the VIX is at an all-time, it's below historical averages. So the market looks at a benign scenario, but at the same time, geopolitical risk and political tensions are continuing to be high. Markets just don't have the ability to price that well. These are binary events, like an election outcome. And so the market looks at those events and only acts once they have some more data and once these events are over. So the underlying performance looks good, but volatility is ahead. And my cautious comments are always fasten safety belts. We're not out of the woods yet. This will be a rocky ride.
Well, let's let Heidi Loon jump in here with a couple of questions, joining us from Australia.
Please.
Yeah, Axel, hi from Sydney, and I just want to pick up on exactly what you just said. We had a resoundingly anti-populist result when it comes to the French elections. It feels like a pro-EU result in a lot of ways, but do you feel like the sort of, breath of relief in the markets, has it come a little bit too soon, in the sense that the kind of existential crisis, not just for the euro, but also globalization at large, isn't really over? We've got volatility at a 24-year low at the moment.
Oh, absolutely, it isn't over. And you could see that the market actually took that relief rally after the first round of the election with Macron ahead. Really, yesterday's final outcome was largely expected. It was slightly better for Macron than what was expected 2 weeks ago. And then actually the next focus will be the parliamentary election, which will have, like in the US, make sure that the president, who's now elected, will have parliamentary support and that he can actually get legislation going. And the concern is, since Macron isn't really backed by a strong party, that parliamentary support might be lagging, and therefore you could end up in a situation where there will be a coalition where they have to make concessions, and some of the very pro-European sentiment that came out of the current election might start to wave again. So, and that's what I see as a pattern. Italy will have an election, and I think with the five-star movement pretty popular and almost head-to-head with the ruling government, there will be more tensions in Europe. And that's what markets really will start to price once we get nearer to the event. At the moment, it's far away, and markets look at the underlying data and take some relief from the fact that the European economy is actually doing well. Growth is above potential. Output gaps will close. Employment will improve. So underlying, there is some good reasons to be positive about Europe. But it could be derailed any time by political events. And that's where we are at the moment. Investors and markets look much less at the economy nowadays and much more at politics in order to understand where the world is going.
Yeah, absolutely, politics and sentiment. But I'm curious to get your views on how you feel about Asia then, because arguably, if you look at this reflation story, the fundamentals for Asia are quite different and you could say quite a bit better.
Absolutely, and Asia, hasn't really been hit by this crisis as much over the last few years. In Japan, you've seen a continuous improvement. We're here in Tokyo, and you're seeing the tightness in labor markets. But yet, what is still missing is that since the Bank of Japan did a massive amount of, new monetary policies, QE, QQE, yield curve targeting, they haven't really achieved the one objective that this policy is geared to, and that is an uplift in inflation. We expect, inflation to be just under 1% this year and maybe 1.5% next year. So that's a change from the zero or negative interest rates we've seen in the past, but they're nowhere near their target. So I see Asia trailing Europe and the US in normalizing monetary policy quite substantially. And the Fed is ahead. And I think the Fed at the moment is looking at implementing another 2 rate hikes this year, potentially 1 or 2 next year, and they're looking for reasons not to stop raising interest rates. So they're more or less on autopilot if the data come in as expected.
Dr. Weber, it's Rashad in Hong Kong. Now, do you think the bank, UBS, is right-sized right now? I want to ask about your business in Asia. There's a lot to answer here. And I've had at least 2 CEOs of Chinese financial institutions saying they want to be the UBS of China. Now, the thing is, what are your ambitions there? Why, you are UBS, so why don't you be the UBS of China as well?
Well, we are the UBS of China, and you know, we're a strong bank in mainland China. We have all the licenses. We have a wholly owned subsidiary, and we work with Chinese counterparties. We're increasing our business there, and actually over the next 5 years, we have committed to doubling our headcount of people in China. We want to basically help expose Chinese investors to global assets. So we bring the global asset base to China with our investment bank, with our asset management, with our wealth management, and we help to give China exposure to global investors who are seeking that through Hong Kong Shanghai Stock Connect, through Hong Kong Shanghai Bond Connect in the future. So we're trying to sort of usually implement being not the largest bank competing with the big domestic players, but being the top international bank that gives international clients exposure to the rest of the world. And it's good that others want to compete with us and want to become the UBS of China, but we are the UBS of China.
Speaking of your banking business, I want to come back to the French election. Has it held wealth management clients back from making investment decisions? Did you see a decrease, say, in the business?
Well, in general, there's been a lot of cautious about investors, and they're sitting on the sidelines. As markets are normalizing, we're starting to see investors come back. In our poll in the US, where we basically poll investor sentiment, after the Trump election, more than a third of our investors said that they're actually getting back out of cash into investment positions. We're long U.S. equity, we're long U.S. high yield, and so we believe that there are opportunities in equity markets, despite the fact that these markets have been on a continuous rally for a number of years and markets are at all-time high. So yes, investor sentiment is improving slowly. And as the course of monetary policy becomes clearer and interest rates rise, we're going to see them come back also more into fixed income markets.